great job of bringing us in. So hope everybody's having a great day today, and I'm just super excited to be here with you all. And again, I'm Reginald Smith, and with Sabre Finance, and I think I'll let the other gentlemen introduce themselves as well, and we'll get started.
Absolutely. And Catherine's already kind of done that, but I'm DeAndre Peace with Live Fund, and we're excited to share this information with you today.
I'm Elijah Davis, Urban Impact, excited to be here. And this is 4th Avenue behind me.
That's right.
All right.
Well, good deal. So we, I think the three of us are not fans of boring presentations or ones that are. I think all of us have been on enough webinars and Zoom meetings and any other hangout that you could do virtually with a video since March. So we want to make sure that we get to the point that this is informative for you all. And so we thought that individuals coming to talk to 3 lenders or 3 entities that have lending capacity, we wanted to provide some scenarios that we normally run into that could provide some clarity around some of the information that we're about to share. So just again, please, if you have any questions, don't hesitate to use the chat box. Drop your questions in there. Another really cool thing that we like to do, that if you're a business owner, we like to know what kind of business you have. And so tell us what industry you're in, name of your company, put it in the chat. I think that would be great, not only for us to understand, but also for the other participants to be able to see what other business owners are here. And then maybe you guys could connect outside of this meeting. But we're going to talk a little bit about, we're going to do 2 different scenarios, Elijah and I. And one of them is one that we see very common that causes a lot of challenges as it pertains to businesses being able to get access to capital or being able to get a business loan. And that those businesses are what we like to call cash-based businesses, or businesses that primarily deal in cash. And so that's a wide range, and we wanted to say that, but some businesses are just cash industries, but some businesses, they just deal primarily in cash, meaning that they don't have a POS system where they're taking debit cards or a debit card machine. They don't really take checks. They primarily just take cash, and the challenges that come along with that. So, so we're going to use that one. We're going to kind of start and talk about that one first. And so, Elijah, so I think we said that you're going to be, what was the first business that we said that we were going to be?
Well, we're going to take it homeschool and be real relevant to the times today. So I am going to be the customer, and I think we've got 3 or 2 scenarios planned today. So I'm going to be Eric for the purposes of this conversation.
That's right. Nice to meet you, Eric.
What's up? Okay, so I just met Reggie at a mixer, the Operation Hope ad, and I heard that you got these loans, and I'm trying to get one of these loans.
That's right.
So, Mr. Smith, man, can you help me? I heard about the PPP loans, and I'm a barbershop.
Okay.
Like 3, I've got like 3 chairs in the shop. And I'm
Okay.
Much less, man. And I'm trying to figure out how I get some of these loans. But I already got the grant at IDLO. I applied for that grant and I got it. So
okay.
Help me what I need to do that.
Got it. So, well, first of all, Eric, I'm really glad to meet you. And so I think that the first thing that we need to start with the Paycheck Protection, or the PPP, is that there is going to be, that normally starts with a bank. And so who do you currently bank with right now?
I think I don't have a business bank account or anything like that, but
okay.
I got at a AmSouth or Regions.
Yeah. Okay, got it. And so you do have a business bank account there, or you don't have?
No, I just got one account.
Okay, so you just got one account. So when you're getting paid normally, when you're cutting hair, or even when you're getting the funds from your barbers, where does that money normally go? How do you guys do those transactions?
Well, I keep a notebook, of everything, all the cash, and then I keep the cash in the box, and then I divvy the cash at the end. I pay the
Got it.
bills first.
Got it. And so so primarily with that, so you have the notebook, and the notebook, are you writing down the customers in the notebook, or tell me a little bit about kind of how are you writing down what kind of file system that you keep in the notebook?
Yeah, yeah. I just say, who my client is when they came in and how
Hmm.
much it was. It ain't real, nothing serious. It's just a notebook.
Okay. So with us being in this situation, I think it's great that you're using a notebook, because there's a lot of business owners that don't keep up with it at all. But one of the things that I really want us to think about is when we go to try to get you a paycheck protection loan, because you have to go to a bank where you have a relationship, or we're going to have to go to a nonprofit entity, what we call a CDFI, or community development financial institution. But since you already have a relationship with Regions or AmSouth, I think it would be great if we could start there. But they're going to ask for some information. So tell me a little bit about your taxes and how you do that.
What do you mean?
Like when you, at the end of the year, um, when you get ready to file your taxes for your business or personally or together, do you do that yourself, or do you have somebody to help you with that?
Oh man, my wife does that for me.
Okay. Got it. Got it. And so, if they wanted to see copies of those tax returns, do you believe that you could be able to get access to those?
Yeah, yeah. I just have to ask my wife when I get home.
Okay, got it. Perfect. Perfect. And so, they're definitely going to want some information about that. Also, do you actually have employees, or do you just have barbers that have their own chair in your shop?
No, I get about like $1,200 in booth rent.
Okay, got it. So now the Paycheck Protection, or the PPP loan, is really designed to help with payroll. And so, do you do payroll for yourself out of the business, or meaning that when you every week, do you have a certain amount that you pay yourself and record that as payroll?
I mean, I don't have a W-2, but I got a notebook, and I just take out after I pay my bills, and that's
Got it. Perfect. You know, I think there's definitely some things that will go. So between working with your wife and then being able to have a conversation with your banker, we could be able to apply for the Paycheck Protection, or PPP. But it's definitely going to take us being able to kind of organize the documents and get it packaged in a way that Regions is going to want that information packaged. Without you having a W-2, I'll be honest and say that that may be a little challenging for us to kind of go that route, but I don't think it's impossible, but it's definitely going to make it difficult to be able to present that information to them, simply because you pretty much deal everything in cash, and then those funds are kind of in a box, and so you don't really have a track record of that money going anywhere that somebody can look back at besides the notebook.
all right. But and that's cool. I appreciate that. So that means, can I get it or not, bro?
And so that's kind of where we're going to have to find out. But again, we're going to have to get some of that documentation to be able to take a look at it and see if we could and have that conversation with your banker to be able to see how we can go about doing that. This was great, Eric. Thank you. So thank you. So DeAndre, um, chime in and tell us what you heard, the challenges as it pertains to funding in this conversation. Expound beyond a
Yeah.
paycheck protection, but just from your lender's hat, tell me what went off and what were some of the red flags that you heard.
Yeah, absolutely, and that was a good job, Eric. I'm not sure we're gonna get you any money, but you did a good job of describing your situation. But that's a lot of times what as lenders what we do see is an individual come in and really needs the money,
Hmm.
really needs the financing. But there are some things I want to get ahead of myself that he has to do before that happens.
Got it.
So as far as for this presentation here, that's a great setup, Eric. That's a great setup because you really kind of describe everything that we're going to be talking about
Perfect.
throughout the rest of this presentation. And also, Reg, that was a good job of building rapport.
I was trying my
Yeah, it was a good
best. I was
job.
trying my best
It was.
to
It
not
was.
make Eric feel hopeless because I
Yeah,
wanted
yeah,
to.
yeah. Absolutely, absolutely. And Eric never did say why he wanted the money.
No,
He
he
just
didn't.
and so that kind of transitioned into why borrow?
Right.
Why borrow? And I'll take this first one here.
Sure.
It's cash flow challenges.
Yep.
And your inventory must be purchased. Employees must be paid or trained, and you got to advertise your business. It's just cash flow. It's just having that money on hand. So that's one reason to go and seek that capital from, like Reggie said, either a bank or CDFI, which we'll talk about in a little bit also.
One of the things that comes to mind when you say cash flow, just for the sake of the conversation, is your normal operating expenses.
Yeah.
I think sometimes business owners are almost timid to ask for money to help them with their normal operating expenses. I mean, when you talk, because these are most of the time, sometimes they're variable, but most of the time they're fixed expenses. I mean, rent, um, or if you have a mortgage, um, payroll, as you said, utilities are a big one in a lot of cases, especially depending on where you're located. There's inventory that needs to be purchased. There may be seasonal, it may be some seasonality to that, right? Say the Christmas time is your big time as a business owner and you need to stock up on a particular item or specific items, and you need some funds to help get you those, because you may get a better rate if you buy in bulk. You want to buy in bulk, and so you may borrow that money. You may get it at a lower cost that may increase your profit margin. So if you normally buy it and it costs you, $3 per unit, but if you buy it in bulk, it can cost you $1 per unit. Now you can take that same price, but your profit margins increases. So I wanted to stress that cash flow challenges is one of the ones that I don't hear a lot about, because individuals traditionally kind of stray away from those things. Like, absolutely, legal fees, insurance, accounting fees, like those are real expenses that business owners have. And, but they kind of stray away from those. And so, yeah. And so, Elijah, if you want to jump in there, we could talk about capital investments or lengthy development cycles, either one of those.
Yeah, absolutely. And I would say even before we move on from cash, at the end of the day, borrowing has to help you make more money and stay in business and make profit,
Absolutely.
right? That is the purpose of borrowing. It is not to replace a bad or broken business model. We're in a context now where we're talking about literal economic injury and disaster that's different than the typical cash flow. Before we talk about loans, when folk come, here and really with all the partners, we want to talk about, well, how are you spending? How are you monitoring your spending? How are you making money? Because
Right.
if you have a liquidity problem and you're not sure of your business model, then it becomes a real challenge, right? And you won't ever, overcome that. So that's really important. And I know it's important to all of us in the microloan space because we want to make sure that people have a firm sort of foundation on the borrowing of money, because we don't want to increase the burden of, what we already see in the marketplace. But particularly, the other piece is really, there comes times where, especially if your firm is expanding, that you need space, like to produce stuff, right? Space to make more money, right? And so when, the cost of the space to make more money spread over time is less than the amount of money you're going to make over that same time period, that's where you believe you can invest. And that's where having access to the money up front and being able to pay it back over that period of time makes sense. But you shouldn't do that when you don't have a customer base, revenue model, profit model, more importantly, that really sort of supports that investment. So that's always the way I try to think about it. It's always that cost benefit analysis. Am I making more money than I have to pay back and then some? Because you could be, just one-to-one paying bills, but no one wants to be a business just to pay bills, right? It's really to make a profit. So
Yeah, and that's so important. What you kind of hit both of them there. With businesses that we have to stress that one of the worst things, in my opinion, that you can do when you have an idea is go out and get a lease. You don't have customers, you don't have sales, and that, but you got a $1,500 lease coming in. At that point, your business becomes a burden. And so we try to look for unique ways and creative ways. I know we're talking about borrowing in this session, but at our hearts we are trainers. We are people that like you to look for resources and be smart about your borrowing. There will come a time, like you said, like when you will have to borrow. But until you get to that time, make sure you're fully prepared by exhausting your other options also. Okay, all right, Reggie, what questions should you ask yourself?
The biggest thing, and this is question for me, is how much money do you need is the biggest question, in my personal opinion, that you can ask. Out after you decide what you need it for, or what you think you need it for, you have to really become very granular about how much money you need, all the way down to if you're going to buy from Amazon, go to Amazon, put it all in a shopping cart. Right? Put it all in the shopping cart and see how much it's going to cost. If it's 3 different websites, put it all in those shopping carts and then print screen or print those shopping carts out and say, hey, this is what I need. A little tip, especially if you're going to a lender, that goes a long way, because most people who come to borrow money, they have an inflated view of what dollar amount they actually need. It's sometimes very high. It's a lot higher than what they actually think. They'll say, well, I think I need about $10,000. And then when we start, like, while they're talking to me, they're like, I need to get this, and I need to get some pots, and I need to get this. And I go on and I'm looking at the machine and I'm Googling, and I was like, well, is it I'll read off, is it a 3,006? I see somebody on one of our participants does dressmaking and embroidery and things of that nature. So I'm asking, all right, is it this particular embroidery machine? And they'll say, yeah. And I was like, well, I see it for $3,000 on Google, and I see it for $3,000. And they were like, wow, I didn't know that. So I think really taking that time to figure out how much it's going to cost you, doing that breakdown. One of the big things that I love about working with the Capital Access team and the Small Business Development Center, and I love to do myself when I talk to people, is they make you sit down and line item how much money is going to go into what bucket, and not put it in one big lump sum. So if it's going to be marketing, all right, we're going to have $500 for marketing. Okay, tell me what you're going to do with that marketing $500.
Right.
Is it going to be Facebook ads? Are you going to pay somebody to do it once a month? What exactly are we going to do with the $500? If it's going to be inventory, okay, tell me what you're going to buy. If it's $1,500 for inventory, list those items out. That tells a lender that you've actually taken the time to think about what you want to do with the money, and it builds confidence up front. So I think that's one of the biggest things that a business owner could do. What about you guys? What do you think about that?
No, I think that's critical, and I know that we have a long history of challenges in lending, but I can tell you, especially folks, mostly every service provider that is in Rebound Birmingham, they want you to list out your expenses, because no one wants you to be in something that you cannot pay back or is not making money for your business. right?
Absolutely.
So that's the reason why that, you know, uh, needs and use document or whatever folks call it. I mean, it's so important to go through that exercise, right? Because what I find often is that folks, are trying to, get, in a proximate amount and give some slack. But the problem is that, it's very precise, right? Business planning, execution is precise. It's an art form, but it's precise. And so if you have, $3,000 extra that you don't need, I mean, that takes away from your cash flow later, right? Just mathematically, because, that's interest, it's principal. So that's really key for me to make sure. And I'll tell you that I'm often excited when people go away and say, you know what, I didn't need as much as I thought I needed. That is like an outcome. I mean, that doesn't, report on the annual report, but
Right.
it's a great outcome.
Yep.
Yeah,
That's a good day.
yeah. When I was little coming up, my mom used to tell us when it was time to eat, don't let your eyes be bigger than your stomach. And so, so basically what she was telling us is, you can't eat everything you see. Everything that's available to you, you don't need that. And so the question that you said, Reggie, is not, not how much you want, how much you qualify for, it's how much do you actually need.
That's right.
I think that's so important. Even when we look back to the housing market in 2008 and coming up with that bubble, when that burst, people were eligible and being qualified for homes that they couldn't afford.
Yep.
And then eventually, that's going to come home to roost. And it's even more so in a business that now you may qualify for 60,000 or 50,000, but you may need 5,000 in a good business plan.
There you go.
And a lot of times, like when you do sit down and they shot the Catherine and her team there. I'm sure they back people down, from 20,000 down. Sometimes to no money. Sometimes you may not have money right now. Sometimes you're not ready for that. And so yeah, definitely how much money you need, and then also decide how much control do you need.
Yeah.
Or how much control do you want? So I know that this is on borrowing. This is not necessarily on equity. But when you sit down with a lender, you need to decide, okay, am I looking at a straight debt loan, or do I want to explore some ideas as far as equity, maybe sharing a piece of my business?
Yeah.
That's easier said than done. There's a whole lot easier said than done. So that's something also to look at.
Agreed. One of the things that I thought that came to mind while we were talking, and I love, and again, you guys just jump in there. If you have questions, thoughts come to mind, put it in the chat. We're pretty active. We're definitely going to make sure that we address it. But one of the things that comes to mind, and this is something that I say frequently, is that some of the best dishes in cuisine that we eat today were birthed out of a lack of resources. Like when I think about, and I go to New Orleans and I think about red beans and rice doesn't cost a lot of money to make, but it is absolutely delicious. Okay. And so, I mean, it's literally onions, bell peppers, rice, beans, sausage, and French bread. I mean, you can make a whole pot of it and feed a family for less than $20. Why is that important as relevant to this conversation is that a lot of times we think about everything that we want to buy as an entrepreneur, as a business owner up front. And oftentimes, to DeAndre's point, you may only need a small piece of it right now to get you go off the ground running. You may only need a small bit of it to be borrowed. Business owners oftentimes are very uncomfortable in that space where the cogs and the wheels are just turning. Like, it may not be a whole lot of extra profit left over. It may not be a lot of money that you're putting over into a savings account. It may be $100. It may be $50. But if you're in the black and you're operating, don't allow that pressure or that afterthought, like, well, what if something happens, force you to make you want to go out and get a loan. A lot of times, if you're in the black every month at the end of the month, that means you're doing good. That means something's working. So, but don't feel like, well, I don't have $5,000 in my savings, or I don't have, $10,000 put away. Don't make that force you to go out and feel like you have to borrow money because you just don't have the reserves that you want to have. That will come. So you have to allow yourself to grow organically. A lot of the micro enterprises that we talk to in businesses with less than 10 or 5 employees, it takes some time to grow. And so allow yourself to go through that process. And as you kind of look for dollars and how to cut costs, that's where that creativity comes in. That's where your most creative ideas come in those pressure moments, or when the budgets or the line items are a little tight, but you're still in the black, and that's where you can become creative. So allow yourself to go through that space.
Right. Elijah, touch on this one here, man. I just want to kind of hear your perspective on, especially in the midst of a pandemic, what type of business do you have when you go to look for funding? For instance, when restaurants are shut down, it's probably not a good time to start a restaurant. When daycares are closed, it's not a good time to start daycare. So if you kind of speak to that, if we were having this presentation, 7-8 months ago, it may be a little different. But kind of speak to now, what type of business it is that you have when it comes to bar.
Absolutely. Thank you. The first thing is that, and this is something that we probably all were unaware of when we, first started a business or work with businesses. But, there are, I think we take for granted that banks are businesses, right? So banks who typically, want to make a profit on the money that they give out through interest, they're looking for the least risky type of investment. And so because of that, we have sort of businesses that are always sometime at a disadvantage from getting traditional bank loans right out of the gate, like restaurants or startups. So typically, up to 2 years is going to be a challenge. Restaurants don't have a high appetite because of turnover and margins and things of that nature. And so the reason why all of that is important is to understand, so what type of business, and then from a market standpoint, like who thinks it's a good idea to give me money, right? And how do I connect with those people? And that goes back to really assessing the type of money and capital available to you that DeAndre talked about a little bit earlier. So that's one piece, is to understand where you can actually get money from. And we'll talk a little bit in the next slide about sort of the traditional and sort of different types of financial institutions. But also something that Reggie talked about a little bit earlier is seasonality, right? That's another piece of, so knowing if your business is seasonal, because most traditional loans have a payback period, that, is fairly steady on a monthly basis. And so, if you don't have the understanding of, how much you're bringing in and profiting every month and how to time that or spread out, that payback, then you're going to be messed up, right? So if you do really well, November through January, but you want to get a loan that's probably a little bit more than you can pay back, I mean, you've got to pay that back, when it's not November through January. Mm-hmm. And so it's really important to know, when you take in the money. And also it's also important to know who your clientele is. From a perspective of a pandemic, this is where there's a lot of concern because, we still have not seen the bottom fall out of the economy, mainly because, people are still demanding a diversity of goods, even with restrictions. Like they still want to go to bars, which means they still want to dress up, which means they still want to drive, which, a whole host of things, right, that are interconnected, with the good or service that you sell. But it's really important, and none of us are prognosticators. You know, we can probably do our best forecasting, but it's really important to understand, not to get into really deep econ terminology, but you know, keep a pulse on your customers and what they want to do, because what they want to do is how they're going to spend. Right.
Absolutely.
And, you know, if people feel unsafe to come out, that's going to decrease foot traffic, but that's also going to decrease retail. That's going to decrease all the other things associated with that. So you have to know if you have a customer base that's going to come back monthly, no matter what, if they're going to be recurring, if they are really sensitive to safety or other external factors. You've got to know your customer base. So that's what I would say to that, particularly in a context of a pandemic, and also in the context of, you know, if you have this stable fixed cost of, you know, this loan is due this, this utility is due this, but your clientele is completely shifting, you may have to shift your business model in order to meet them, if that's even possible.
Agreed. 100% agree.
Absolutely.
And that's something that you don't have to figure out alone. And I think that's what this whole process is about with Rebound Birmingham or Rebound BHAM. You know, we are like screaming to the mountains, like, hey, if you hear something that alarms you or says, I don't know how to do that, or I probably need to do that, please get in contact with one of us, because we want to help you. And most of us, the majority of us, or not all of us, do it at no cost to the participants. So please reach out to us. Let us know, hey, I need help doing this, and we'll make sure you get what you need.
Right. And I'm gonna set this next one up. Now I'm gonna turn it over to Reggie. This is his passion. The other point was, you know, what type of finances should I get? And so before we get into these main two out here, you know, that there are other ways that you can get finances, such as, you know, crowdfunding, and you can bootstrap. You know, you can. There's tons of methods out there. You know, rent instead of buy, or, you know, or lease, or borrow, or barter and trade. There are tons of methods out there. But today we want to talk about I guess you would say, the two main ones. I will say, before I hand this over to Reggie, be wary of shark loans. This is not necessarily a presentation on that. Be wary of the merchant loans. I told a customer the other day, I said, no, if you hear a commercial on the radio for it, that's probably your sign. Right? I mean, really, that's probably your sign. You know, come get a loan, 24 hours, no documentation, no business plan, none of this. So those are ones to stay away from, because every partner in Birmingham, in this collective with Lift Fund, True Fund, Sabre, SBDC, everybody, we've seen customers that have fallen victim to those loans, and they're spending $3,000 or $4,000 every week, or $1,000 every other day. And so just kind of stay away from those. But we do want to talk about where to go, Reggie, when I do need capital.
So I had a thought, and then Ms. Deborah asked a question. So I would like to honestly let Elijah start to talk about the crowdfunding method, and kind of talk about the product that they have to offer as well, just to kind of give an idea around what that concept is, because I think that's still cloudy for a lot of people. I think we make an assumption that people really understand that, they know what crowdfunding is and how it really works. And so, Elijah, would you mind speaking to that process, and kind of what goes, how that can be beneficial to business owners?
Yeah, absolutely. And Catherine has, you know, as always, a gift for simplicity. Crowdfunding is where many people give a small amount to make up a total. So crowdfunding is just really is a newer word for putting your money together, you know, pooling it, except for it's now on a platform, right? So
dollar up.
Exactly.
That's what it's called.
And so when we now put our money together and pool our funding, now there are some organized platforms that have done that. So one platform that really popularized this about 10 years ago in the national sort of scene was Kickstarter. And this is where folks who could not, for a lot of reasons, get loans because, there probably just wasn't the right match for Super Risky, went on Kickstarter and started raising money for projects. And but also 15 years ago, a organization called Kiva started something called crowdfunded loans, right? So it's this notion that I'm not giving away my money and never see it, but I just actually um, loan you $25, and as you pay the pool back, the rest of the lenders get paid back over time at 0% interest. So I don't make a profit. It's what we call sort of social impact, and so I just get it back. So the reason why they asked us to talk about it, and this is probably the first public announcement, but Urban Impact became the Kiva hub for the Birmingham region, serving Jefferson and Shelby County, of which I am now, as of like last week, the capital access manager, which in short means that what we do is basically we just help you apply right through the platform, but the product is not for everyone. It really is for businesses who have a strong online presence and businesses who have not probably raised funds elsewhere in the marketplace and exhausted their personal network. So it's really geared toward those startups or folks who have not used their personal networks, because before you can go into the online platform and access, a million plus lenders who can invest in you, you have to raise, $25 for 15 to 25 people. And that's something that they call social underwriting. So Kiva is more lax on some of the traditional credit methods that we'll talk about, but they're basically saying, well, if people know you and they vouch for you and people have spent with you, then that's what we'll use. And so it's a very unique tool. And I'll conclude by saying that the reason why we felt it was important to bring this particular product to the marketplace is because, there's a whole range of financial services and products, and that there was a whole range of people who just really needed to get going, and that may not be appealing to other types of institutions. So we're just the first, probably, as they call it, the first step in the capital ladder, so to speak, and we'll move up the ladder with Reggie and his CDFI.
Good deal. No, thank you so very much. I think that's so critical because we get business owners at different steps all the time. And when we say that you don't need to take out a loan, we don't mean that give up and quit and come back later. That means that there just may be another option available. We're just saying don't take a traditional loan right now. So there are other options, and I thought that was critical. And thank you so much, Elijah, for saying that. I want to talk a little bit about just banks versus CDFIs, and this is not going to be boring, I promise you, but I do want to paint a picture for you guys. So with banks, they do have lower annual percentage rates. I want people to understand what a low annual percentage rate looks like for a business loan. Because oftentimes when they come to a CDFI or a non-traditional lender, I want you guys to be able to gauge kind of what's really high and what's comparable based upon the risk, or APR, annual percentage rate. All right. So at a bank, when I was in corporate banking, I was doing commercial loans. I was working at I was working at the #2 bank here in the state of Alabama. And what I was doing was doing loans for business owners between $1 million and $10 million in revenue. For my best client, who had about $5 million in revenue every year, and they had about $500,000 in the bank. The best interest rate that I can give them for a project that they were working on was 8.5%, which was prime plus 3 and some change. What that basically means is the loan is based off of the US prime rate, which you can Google and find that fluctuates, and the bank adds something to that to make a profit off of. We talked earlier about banks are businesses, so they're not giving away free money. That's just the way it works. I don't bash banks. I tell it like it is so that you can be informed. So banks have a very valid place, but you have to understand how banks work to be able to navigate with them. So they take the US prime rate and they add to it. So my best client was 8.5%. At a CDFI, some of the lowest rates that I've seen are like 9.125 up to 12% at at good CDFIs. Okay. DeAndre, you can step in at any point. When you start tipping over into 15 plus, in my personal opinion, I don't have a scale to prove it. I'm thinking that you're getting over into high at that point. Would you agree with that, DeAndre?
Well, we like to say anything that's less than your credit card. So anything under 19.9.
Okay.
Yeah,
Okay.
anything
So
under 19.9.
I'll go with that. So when you
Yeah.
start tipping over into the 20s,
Right.
I've even seen 50% on a loan for a small business because they needed the money so fast. They felt like they needed the money so fast and they went out and got it. Okay. So I wanted to just throw that out there because I get a lot of conversations about interest rates and people always be like, man, that's high. 9.125, that's high. But in all actuality, for the risk, and I'll talk about that in a minute, that's very comparable. With banks, you're going to have most of the same paperwork. We'll talk about that in a little bit, but the major difference is with financial institutions or traditional banks that you want to look at, because I want to give you something different. You get the normal stuff, is look at the size of the bank. That's very important. There's something called the asset size of the bank. Based upon that bank's asset size is going to determine how close you can get to the underwriters or the people who make the credit decision. If you go to some of the larger financial institutions in the state of Alabama, most of the time you're going to fill out an application and they're going to send it off to what's called a centralized underwriting platform. That means it goes off to somebody and there's a group of underwriters who sit, it goes in a queue, they pull it, and then they look at a laundry list of things and they make a decision, or their system automatically makes a decision for them. Okay. As their bank gets smaller, you may get to sit down with Mr. James, who is the commercial lending officer in your area, and you can tell him your story, and he may have something called lending authority to make a decision. I'm still talking about banks, okay? This is for banks. So the largest bank in the state of Alabama is Regions Bank. Regions Bank has $132 trillion in assets. For small businesses, micro enterprises, even if you have $10,000 in the bank, that's a long way from $132 trillion in assets. It doesn't mean that you don't matter. Okay. It doesn't mean that you don't matter. It just means that your $10,000 is a very small dollar amount in that particular financial institution. Banks use your money to lend money and to go out and buy other things. So the more money you have in the bank, compared to their asset size, the more valuable of a client you are. That's just the way it is. Don't take that personal. The beauty that you have as a small business is to find a bank that's comparable with the money that you have. So if you find a smaller bank who has maybe somewhere in the ballpark of $200,000 in assets and you have $10,000, that $10,000 is a little bit more noticeable than if they had 132 trillion. So if you have other questions about banks and navigating with them, we're going to talk about documentation, but I wanted to throw that out there. With CDFIs, community development financial institutions, were brought up during the Clinton administration. They were designed, that whole fund is a fund, it's a CDFI fund. So when people say we have a CDFI or we are a CDFI, what they're saying is there is a federal arm under the US Treasury that's called the CDFI fund. Entities have to apply to the US Treasury to become a certified community development financial institution. Once that happens, they are saying that they are willing to serve, or their mission is to serve businesses that operate in low income, operate in underserved communities, operate to serve minorities and disadvantaged business owners, people who have challenge getting money at the bank. If you fall in that category, it is in your best interest to reach out to a CDFI to be able to get funds. Most of those CDFIs are also going to be micro lenders with the SBA. So they wear dual hats. So not only are we a CDFI and we get money from the US Treasury, we're also a micro lender and we operate in the SBA micro loan program. So they can be able to be more creative. They may or may not take collateral, meaning that you may get a completely unsecured loan, meaning that you don't have to put up a house or a car or the equipment that you have as collateral, depending on the organization. So those are some very critical things that I wanted to hit on. I didn't want to go too far in the weeds, but I do want to leave that kind of cliffhanger in case you guys have some questions to be able to ask. DeAndre, Elijah, would you like to jump in there and add anything to that? And so I kind of wanted to give him something, but I didn't want to go too far in the weeds and make and become Charlie Brown.
Well, no, I think I appreciate you, Reggie, for really categorizing that. And so, in the sake of time, I'll go through the remaining slides and make sure that we have time for questions. Sure. So, when we talk about knowing what type of business, what type of clientele you have, and then also understanding what financial institution is going to be potentially best for partnering with you in your business. Then there are some things on your end that you have to be aware of. And so one, most people are familiar with the credit score, which is really just sort of the general score of just, okay, if I give you the money, can I be in a partnership with you on paper? We know that there are some external factors in that may be skewed, but for general, that is that representation. Can I partner with you? And that's sort of that score. People want to see that, you may not have everything buttoned up, but if you have been making money for a minute, then I can at least trust that you're going to continue to make money. And so that's the thought behind that. And then also, are you going to be able, do you have the space to make the payments? And that goes back to our earlier conversation around, borrowing more than your revenue and profit will allow, right? I mean, the point of borrowing is to get you to make more money, and that more money ends up covering the payments and then some, right? So that's key. You can go to the next.
One point on that. Can you make the payments? Also, we're taking a look at your personal financials. In that, yes, because your business is not making any money right now, and so I think Catherine put in the notes that cash is king. I mean, it's king. If you have $100 left after we look at your global cash flow, you can't hold a $200 payment on a loan, or $300 payment on a loan. So it's just not your business financial, but it's also your personal. Okay, go ahead, Elijah.
Absolutely, and this is so when we think about the basics. What is sort of your what is your profile page as a borrower, right? When you are selling, you're putting out your best, face, your best product, your best marketing to gain more customers. You've got to think about that in the same way. That's what we call the required documents list, or when we say what you'll be asked to provide. Here is a general list of what most lenders, investors, people who want to partner with you, they're going to ask you to provide. And so you don't have to be in the market for a loan, to be able to pull together these documents. These documents you should be pulling together and make sure you have them at all times. And Catherine, I do want to address such a key piece of the lending process that you just noted was the global cash flow analysis. You don't have to be a mathematician, but literally look at all the money that you bring in and then all the money that you pay. Then add a payment to that. And if you can't afford that, then you cannot afford a loan. And that is the standard that banks, institutions, they all look at that, right? And that's the secret sauce, if you will. That's what's in the Krabby Patty, is on the top, how much you bring in, on the bottom, how much you put out, and then add a loan payment to that. And if you can't make that work on your paper, on your smartphone calculator, you're not going to make it work anywhere else. And so that's where you would definitely like that. But going back to required documents list, the business plan really spells out how you're making money and why it's viable over time. Your tax returns, this is so key. Going back to our piece, I mean, it's important to have a formal statement of your income, and that's your tax returns, right? You won't be able to apply for anything really without that. And then your bank statements really show on a cash flow level, are you faking the funk, right? If you're depositing, and we strongly encourage you have a separate business account, if you in deposit what you're doing, so that's a mechanism to show. Business financial statements, that's how much you made, how much you put out in a formal document. And then also we want to just see that you went to the state and registered in business. And so when you think about this, it doesn't sound, when you think about it, that we just want a formal document of, what you made, what you pay, and that you exist. That's what you should have. And so I know all of these things from a bookkeeping standpoint can be challenging, but it's important. Let's go to the 5 C's of credit and open up for questions.
Sorry, Elijah, I just want to jump in here. All of those documents are why this partnership of all these Birmingham organizations exists, because we know that these are difficult to pull together. We know that writing a business plan is not fun to do on your own. Figuring out what pieces of your tax returns or how to get your annual credit reports, what you should use to pull your financial statements together, what goes on a personal financial statement as an asset or a liability. That is where we come in to help. This is just an introduction to these topics. We want you to know that we're here to help you with all of them.
Thank you so much, Catherine.
Absolutely.
And that's key. And as we close, I mean, really, this is what most people say lending and borrowing is all about, right? This is, what you've personally invested, the purpose of the loan, condition, capacity, how you plan to repay, collateral, anything, any assets that can help make people feel more comfortable, and character, which is really important. Is your business viable? Are you viable? Do you deal ethically? Do you have a good track record? And so this is a summary of that. And today we've hoped to just give you, this could be a very in-depth, topic. This is a very deep sort of industry, but we hope that we provided sort of the basics and essentials for you today. So I know that we're up on time.
Yeah, we're almost there. One last thing, and then before we get some questions, Catherine, is that I like to tell customers it's almost like a fire hydrant. The fire hydrant analogy that I love to use. Like, when is the best time when is the worst time to buy a fire hydrant? Or whether it's when your house on fire. That's the worst time to go look and try to buy a fire hydrant, because your house burning in. So when is the best time to seek business finance? Well, the best time is when you don't need it, right?
Yeah.
The best time. So all the things that we've been talking about, getting that's going to the store and buying a fire hydrant. You're getting your business plan together, getting all your your information together. Because who knew that the government, we're going to have PPP loans this year, EIDL loans, and all that. And a lot of people were running to buy a fire hydrant when the house was burning. But the ones that were successful, the ones that already had that fire hydrant, and they put the fire on the house. So go ahead and start getting everything together. I think, Catherine, this copy is going to be available at some point. And so we'll transition on to the question if we have any.
Yep. And again, we can help with this. Any of this stuff that we talked about, we can help with it. So we want to over communicate that. Please reach out to us, whether it's on Facebook or you get our email off of these things. you Google our organizations, please don't hesitate to reach out to us to get some assistance.
And that's at no cost. Let's put that in there.
Our contact information
Yeah.
will be available through the follow-up email that will follow this. The slides will also be available through the email, and then at some point in the future, we're still kind of working out the details on what we're going to do, but we have recorded this session, and so the recording will also be made available. So I'd like if you all have another second, I'm curious, do you have a sense of the seasonality of your own businesses? Drop a yes or no into the chat if you've got a good sense of that seasonality that impacts your businesses.
Good one.
Awesome, we're getting some yeses coming in. So
Right.
from my perspective, I'm not a lender, but almost every business has seasonal fluctuations, whether that's on a micro level on the daily basis, and you'll have to excuse my puppy in the background, or if that's on a monthly or annual basis. There are very few businesses that don't have that seasonality. And so thinking about where you need to save to be able to create that cushion over time is going to allow you to either smooth out your cash flow payments to yourself or smooth out those cash flow payments overall to repay some debt.
Sweet. Again, go ahead, Elijah.
Well, I will say this: the one vehicle we didn't talk about a lot that, and this is just really important, is cash flow lenders. Right? Square has a product on deck, Kabbage, and that seems like a really good idea to get some capital fast. But we strongly advise you to at least go through these processes to understand your business, because it will sap out your liquidity and rob you in the long run. And I know that in times like this is very difficult, but that's something, if I've seen one thing to really kill retail businesses quickly, it is that. So,
It's a So you'll always be able to find somebody to lend you money. The question is, how much are you paying for it?
That's right.
Give up. Are they connecting to your bank account? Are they going to open new credit accounts in your name and potentially ruin your credit? I think we've seen that happen a couple times, and it's hard to turn that around, and it's really hard to get out of those deals to refinance them because your cash just gets sapped away. And so, I mean, getting money from anybody except your customers, there's a convenience fee to that. So the convenience fee for a traditional loan is the interest rate plus prime, or the prime rate plus the little cap that they put on.
Yep.
The convenience fee for crowdfunding is the crowdfunding platform's fee. The convenient fee for credit card transactions is that transaction processing fee of, whatever the percentage is, plus usually like a penny or a nickel. So there's always a cost to that transaction. The question is it worth it? Do you need it? A lot of times the answer is yes. And we just want you to know that there are really good resources, that you don't have to do this on your own. And if you have any questions about whether a lender is what we call predatory, that 95% annual percentage rate or that daily percentage rate that comes out of your accounts, you can always talk to us, talk to a colleague, your banker, talk to somebody about it. These are not secret issues. Money right now is too much in front of us to be a taboo issue. And the more we talk about it, the easier it is to talk about. So if there are any other questions, feel free to reach out to us either individually or reach out to Rev Birmingham, who's done a wonderful job organizing all of this. And with that, we'll call it a day. So thank you everyone so much for joining us today. We really appreciate your participation, interest, and input. Thanks everybody.
Thank you.